Preparing for FP&A Analyst at Telefonica interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a telecom company such as Telefonica? FP&A connects Telefonica's operating decisions with financial performance. I would help build budgets, refresh forecasts, explain variances, and provide management with insight rather than simply reporting numbers. In a telecom business, that means linking subscriber growth, ARPU, churn, handset subsidies, network costs, and spectrum investment to revenue, EBITDA, and cash flow. I would also challenge assumptions constructively and ensure leaders understand both the immediate result and the longer-term financial consequences of their decisions. While answering, focus on budgeting, forecasting, performance analysis, business partnering, cash discipline, and translating operational metrics such as customers, ARPU, churn, and network investment into financial outcomes. Question 2. How would you build Telefonica's annual budget? I would start by understanding group guidance, strategic priorities, and the planning timetable. Then I would build a driver-based model with assumptions for subscribers, ARPU, churn, traffic, headcount, energy, supplier costs, capex, and foreign exchange. I would validate those inputs with commercial, network, HR, and procurement teams, challenge inconsistencies, and prepare base, upside, and downside cases. Finally, I would consolidate business unit submissions, reconcile them to corporate targets, document assumptions, and secure approval. Make sure to cover the planning calendar, top-down targets, bottom-up assumptions, operational drivers, cross-functional challenge, scenario analysis, consolidation, and clear ownership of assumptions and deliverables. Question 3. How do you forecast revenue for a telecom operator? I would forecast service revenue using customer volumes and ARPU rather than applying a simple growth percentage. The model would roll forward opening subscribers with gross additions and churn, then segment customers by mobile, broadband, prepaid, postpaid, and business products. I would separately model equipment sales, wholesale revenue, promotions, and seasonality. I would compare forecast drivers with billing and commercial data, investigate unusual movements, and update assumptions when customer behavior or pricing changes. In your answer, talk about customer base movements, gross adds, disconnects, ARPU, product mix, contract timing, equipment revenue, wholesale income, seasonality, and reconciliation to actual billing data. Question 4. Which KPIs would you monitor in Telefonica's monthly performance review? I would monitor service revenue, total revenue, EBITDA, EBITDA margin, operating costs, capex, and operating cash flow, then connect them to operational indicators. These would include mobile and broadband subscribers, net adds, ARPU, churn, customer acquisition cost, traffic, and network availability. I would segment results by country, consumer, business, and product. The key is not just tracking whether a KPI moved, but understanding the commercial or operational cause and its financial implication. Be sure to mention financial and operational measures, including service revenue, EBITDA, margin, capex, cash flow, subscribers, ARPU, churn, net adds, customer acquisition cost, and service quality. Question 5. How would you explain an unfavorable EBITDA variance to senior management? I would begin with a bridge from budget to actual EBITDA, separating revenue and cost drivers. For example, the variance might reflect lower net adds, promotional pricing, higher energy costs, supplier inflation, unfavorable mix, timing, or a one-off charge. I would quantify each item, validate it with the relevant owner, and distinguish recurring from non-recurring effects. I would finish with the forecast impact, corrective actions, and any decision required from management. Focus on quantifying the variance, separating volume, price, mix, timing, foreign exchange, and one-off effects, identifying controllable actions, and presenting a concise bridge from budget to actual performance. Question 6. What is driver-based forecasting, and why is it useful at Telefonica? Driver-based forecasting builds financial expectations from the operational factors that create results. For Telefonica, service revenue could depend on subscribers, gross additions, churn, ARPU, and product mix, while network costs may depend on traffic, sites, energy prices, and supplier contracts. This approach is more transparent than applying blanket growth rates because managers can challenge the assumptions directly. It also makes scenario analysis faster and assigns accountability to the teams influencing each driver. While answering, define operational drivers, explain their causal relationship with financial outputs, distinguish controllable from external factors, and show how drivers improve forecast transparency, speed, and accountability. Question 7. How would you analyze a significant increase in customer churn? I would first confirm the definition, period, data quality, and whether the increase is concentrated in a particular market, product, cohort, or customer type. Then I would examine pricing changes, competitor offers, network performance, complaints, contract expiries, and retention activity. I would estimate lost subscribers, ARPU, revenue, EBITDA, and acquisition costs required to replace them. My recommendation might combine targeted retention offers, service improvements, and a revised forecast reflecting the new customer behavior. Make sure to cover data validation, cohort and segment analysis, competitor activity, pricing, service quality, customer complaints, retention costs, revenue impact, and recommended commercial actions. Question 8. How would you assess a proposed 5G network investment? I would assess both strategic and financial value. The model would quantify incremental subscribers, ARPU, enterprise revenue, traffic capacity, avoided costs, rollout capex, maintenance opex, spectrum implications, and timing. I would calculate NPV, IRR, payback, and cash flow under base, upside, and downside cases, with sensitivities for adoption, pricing, rollout delays, and equipment costs. I would also consider coverage, competitive positioning, regulation, and whether the investment supports Telefónica's broader network and customer strategy. In your answer, discuss strategic rationale, incremental revenue, capacity and quality benefits, capex and opex, utilization, NPV, IRR, payback, sensitivities, and execution or regulatory risks. Question 9. How do you distinguish capex from opex in FP&A reporting? I distinguish capex from opex based on whether spending creates or substantially enhances a controlled asset that provides future economic benefits. Network equipment, certain software development, and construction projects may be capitalized when accounting criteria are met, routine maintenance, repairs, and operating services are generally expensed. I would verify policy, supporting documentation, project stage, and approval status, then assess depreciation timing. Consistency matters because classification affects EBITDA, capex, depreciation, cash flow, and performance targets. Focus on the accounting nature and business purpose of spending, capitalization criteria, useful lives, depreciation, project governance, recurring maintenance, and consistent treatment under applicable accounting policies. Question 10. How would foreign exchange movements affect Telefónica's forecast? I would separate transaction exposure from translation exposure. A local operation may earn revenue and incur costs in the same currency, limiting operating risk, but its results still translate into Telefónica's reporting currency. I would forecast each market in local currency, apply approved exchange rate assumptions, and present constant currency and reported views. I would also identify mismatches such as foreign currency debt or equipment purchases, incorporate hedging where relevant, and show sensitivity to material rate movements. Be sure to mention transaction and translation exposure, local currency operations, revenue and cost mismatches, constant currency analysis, hedging, scenario rates, and impacts on consolidated results. Question 11. Tell me about a time you improved a forecasting or reporting process. In a previous role, monthly reporting relied on manually combining several spreadsheets, which created delays and version control issues. I mapped the process, standardized input templates, added validation checks, and automated recurring calculations through Power Query. I worked with budget owners to agree definitions and ownership, then documented the process and tested the output against prior reports. The cycle became faster, errors declined, and managers received commentary earlier, allowing more time for analysis and decision support. Focus on the original inefficiency, your specific actions, stakeholder collaboration, controls introduced, measurable time or accuracy improvements, and how you ensured the solution was sustainable. Question 12. How would you prepare a monthly management pack for Telefonica? I would structure the pack around decisions, not data volume. The opening page would summarize revenue, EBITDA, margin, capex, cash flow, and the outlook, highlighting the largest movements. Supporting pages would show country, segment, and product performance alongside subscribers, ARPU, churn, and network metrics. Each material variance would have a quantified bridge, explanation, owner, and action. I would reconcile every figure, use consistent definitions, and tailor the level of detail to the audience. In your answer, cover executive summary, actual versus budget and prior year, KPI trends, variance bridges, forecast updates, business unit views, risks, actions, and concise visual communication. Question 13. How would you forecast operating expenses for a telecom business? I would forecast opex by cost category and business driver. Headcount would reflect opening employees, hiring, attrition, salaries, bonuses, and restructuring. Network costs would consider sites, traffic, energy prices, maintenance, and supplier contracts. Marketing and customer service would link to campaigns, subscribers, acquisition, and contact volumes. I would separate committed, discretionary, fixed, variable, and one-off costs, incorporate inflation and savings initiatives, and reconcile the forecast to procurement and workforce plans. Make sure to cover headcount, payroll, network operations, energy, marketing, customer service, suppliers, contracts, inflation, seasonality, cost initiatives, and distinction between fixed and variable expenses. Question 14. How would you evaluate a customer promotion offering discounted broadband or mobile pricing? I would compare the promotion's incremental economics with the expected baseline. The analysis would estimate additional gross adds, discounted ARPU, conversion, churn, handset or installation costs, network usage, retention, and any cannibalization of existing customers. I would calculate contribution margin, payback, and customer lifetime value under different adoption and churn assumptions. After launch, I would track a control group or comparable cohorts, test actual performance, and recommend continuing, adjusting, or ending the offer. While answering, focus on incremental customers, ARPU dilution, churn, acquisition cost, cannibalization, retention, gross margin, payback, lifetime value, and controlled post-launch measurement. Question 15. How would you handle conflicting data from finance, commercial, and network teams? I would avoid choosing a number based on authority or convenience. First, I would clarify the metric definition, period, scope, and source system, because teams often report different populations or timing. I would reconcile the figures to the general ledger, billing data, or approved operational report, identify the bridge, and agree a documented definition with stakeholders. If uncertainty remained, I would present both views, explain the impact, and escalate with a clear recommendation rather than an unresolved disagreement. Be sure to mention definition alignment, source system hierarchy, reconciliation, transparent assumptions, respectful challenge, documented decisions, and escalation only after attempting practical resolution. Question 16. What is the difference between a budget, forecast, and latest estimate? A budget is the approved plan, normally set before the financial year and used to establish targets and resource expectations. A forecast is an updated view of what performance is likely to be based on actual results and current assumptions. A latest estimate is often the most current forecast used for near-term management decisions, depending on company terminology. I would compare actuals with budget to assess performance and with forecast to assess predictability and corrective action. In your answer, distinguish the approved financial plan from the updated view of expected performance, explain timing and accountability, and discuss how variances are measured against each reference point. Question 17. How would you build a downside scenario for Telefonica? I would build the downside from identifiable business risks rather than applying an arbitrary percentage reduction. For example, I might model weaker gross adds, higher churn, ARPU pressure, energy inflation, adverse foreign exchange, and delayed benefits from network investment. I would link each assumption through revenue, EBITDA, capex, working capital, and cash flow, then quantify the effect by market. Finally, I would identify mitigations, such as discretionary spend controls, supplier actions, and revised investment timing. Focus on realistic linked assumptions, such as higher churn, weaker ARPU, inflation, energy costs, FX, delayed capex benefits, and management actions that protect liquidity and profitability. Question 18. How do working capital movements affect cash flow analysis? Working capital explains why accounting profit does not automatically convert into cash. Higher receivables consume cash when customers have not yet paid, while higher payables or deferred expenses temporarily support cash. In Telecom, I would examine collection performance, billing cycles, handset inventory, supplier terms, commissions, contract assets, and seasonal movements. I would reconcile the working capital bridge to the balance sheet, identify operational causes, and incorporate realistic collection and payment assumptions into the cash forecast. Make sure to explain receivables, payables, inventory, contract balances, billing timing, collections, supplier terms, seasonality, and why accounting profit does not equal cash generation. Question 19. What controls would you apply to an FP&A model? I would design controls around the model's key risks. Inputs should have named owners, source references, dates, and locked formulas where appropriate. I would include checks for balance sheet movements, totals, sign conventions, missing data, and actual-to-source reconciliations. Version control and change logs would prevent overridden assumptions, while access permissions would limit unintended edits. Before distribution, I would perform an independent review, compare outputs with prior periods, and document material judgments and approvals. In your answer, cover input ownership, version control, formula checks, balance reconciliations, access controls, audit trails, independent review, documented assumptions, and protection against accidental changes. Question 20. Why do you want to join Telefonica as an FP&A analyst? Telefonica appeals to me because it combines a large, international telecom platform with ongoing changes in connectivity, digital services, customer behavior, and network technology. That environment creates meaningful FP&A questions: how to balance investment with cash returns, improve customer economics, and translate operational data into decisions. I would bring strong financial analysis, disciplined modeling, attention to detail, and clear communication. I am particularly motivated by partnering with non-finance teams and learning how each market creates value. Be sure to connect Telefonica's scale, telecommunications transformation, data-driven operations, sustainability, and international footprint with your analytical skills, curiosity, communication, and interest in business partnering. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.